Welcome to the Blue Collar Millionaire Show. I am your host, Chad Hufford, and this is the podcast where we celebrate the unsung heroes of the working world. Each week, we dive into the incredible stories of honest, hardworking folks who have found financial success through grit, determination, and good old-fashioned elbow grease. So if you're ready to be inspired and learn how to turn your hard work into your own success story, you're in the right place. This is the Blue Collar Millionaire Show. Hello again, everyone. This is Chad Hufford, and I'm with Greg Parrott, and we are doing the Blue Collar Millionaire Show, and wanted to talk a little bit today about risk. So Greg's background is welding. Mm-hmm. And we were joking about yesterday how when you were teaching welding, right, it happened more than once that you had a kid set themselves on fire.
Yep. Yeah. And myself. Yep.
And yourself. Yeah. And like, so when some teachers like, you had a bad day at school, like you really had some bad days at school.
Oh, and the worst one was I had this student when I taught at UAA who he was deaf. He couldn't hear. And so he was on fire. And we were trying to yell at him to tell him that he was on fire. And he couldn't hear it. So we had to like go physically like point.
Tackle. Okay.
Yeah.
Okay. Well, so I have never really welded. When I was younger, a couple guys tried to show me a couple things, and I've had probably a bad relationship with fire, but a little bit more intrigued than I should have. Yeah, so we actually come from a long line of pyromaniacs, I think. Okay. So my dad actually burned down the field behind his house as a kid. And then when I was 10, I started the woods on fire behind my house. So I'm hoping it's not like a generational genetic thing. So we actually built our house on the site where a restaurant had burned down up on the hill 40 years ago. We figured they've already got their fire out of the way. Right. So anyway, so
you have sprinklers in the yard, do you?
We do. We do actually have sprinklers in the yard. Yeah. So yeah, welding would have never been in my cards, but still, like life, it doesn't matter if you're a welder, plumber, pipe fitter. Mm-hmm. Doesn't matter if you're just pushing paper. Like there's no such thing as no risk. But a lot of the folks that we work with in the blue collar industries, in the trades, there seems to be a more obvious form of risk. You know, again, we've worked with a lot of law enforcement. We've had just this summer multiple clients that have been involved in shootings. Trying to defend our community and firefighters. You know, everybody else is running away from the fire; they're running in. Some of the welders, electricians. Electricity is another thing I try to stay away from. Yeah. But when it comes to investing. So people are willing to accept a certain amount of risk in their lives as just normal and necessary. But when it comes to investing, I think a lot of people misunderstand risk and they seek to eliminate it from their investing process. And I believe that in some ways it's a fool's errand, because it's really not about whether something is safe or risky. It's about what kind of risks are you willing to take?
Yeah, that makes sense. How are people trying to mitigate this risk that you're talking about?
Well, when you sit down with people, Greg, in the context of investing, when people say risk, what are they typically referring to?
Losing all their money. That's one of them, of course.
Yeah, I mean, I think a lot of times, that's the fear. Mm-hmm. Yeah, that's the fear that I'm going to run out of money or end up broke on a park bench in retirement or dependent on my family or something like that. But when people talk about risk, a lot of times what they're referring to is volatility.
Yeah, volatility, exactly.
And so the fear might be losing all their money. but what they're responding to is a temporary drop in the value of their investments.
Yeah, certainly. And I think that's what people normally focus on is like, hey, did you see what happened the last time?
Yeah. And that's what gets their attention because it's very obvious. But a lot of people are treating volatility like volatility is the enemy. And don't get me wrong, like volatility, as you said, it's obvious. It gets our attention. Like, did you just see what happened last time? Last time could have been 2 weeks ago. It's not abnormal for in various index or any index to drop 5 or 10% in maybe just a week or so. To drop, I mean, the average decline according to the S&P 500 in the U.S. broad market since 1980, the average intra-year decline is almost 15%. Wow. And most of those years are strongly positive. Mm-hmm. But at some point, there was a temporary decline of at least 15%. And about every 4 or 5 years, we have a decline of about 30% or more. But again, they've been temporary. But it gets our attention, so it gets people worked up, and it steals the focus off our long-term plans. And they are scary. They certainly come with a lot of ambiguity and uncertainty, but there's a world of difference between a temporary decline and long-term permanent loss. Mm-hmm. But what a lot of investors do is they panic in the midst of that, or they're afraid of some economic storm cloud on the horizon, and they pull that money out fearing this decline and end up hurting themselves much more than if they had just ridden that out.
One of the big declines was, of course, when COVID hit. There was that huge market decline. How big was that? It was 40%.
It was, well, it depends on what index you were looking at. So small companies went down more than 40%.
Wow.
But the S&P 500 went down 33% in 30 days, in a month. So it was the fastest, sharpest decline. And it happened so fast that you couldn't get your money out fast enough. And then within just a few months, the S&P 500 was breaking all-time highs again.
I think one of the questions I get most often is how do you retire in the midst of a 30 to 40% market decline? If I'm planning on retiring on the day that COVID happens, now what do I do?
Well, and I think there's a bigger misconception behind this, Greg, is people focus on principal rather than lifetime income. Mm-hmm. And people probably heard us use the orchard metaphor before, but it's this idea of during your career, you are planting an orchard. And the idea is the goal is to build that orchard up large enough where you can just live off of the income, the fruit it produces. You don't actually have to sell off the trees. Now, if you have an orchard worth $2 million and you're getting ready to retire, nobody wants to see that dip to 1.7 right before they retire or right after. But it's not about how much that is worth the day you retire or 6 months later, a year later. It's how much can those investments, how much can your orchard produce in income over your lifetime? And people get so focused on principal because that is what is obvious. You can look that up in a moment. And we both know people that's like their login screen is their investments, right, and what their orchard, what their trees are worth at any given moment. Our concern is not how much your trees are worth today, tomorrow, or next week, but how much income can they produce over a lifetime? That's what the focus needs to be. And that also raises another question is, well, what is the risk that I should be worried about? And financial independence, as you would agree, financial independence comes from income.
Right.
Everybody focuses on principal, but your income is what gives you the opportunity to no longer need a paycheck anymore. But income is about purchasing power. Mm-hmm. And when people think about money, they typically think about units of currency. They think about pieces of paper with dead presidents and or Ben Franklin.
Right.
But that isn't actual money because that declines in value over time. So if we have a financial cancer eating away at the value of our income, that's what we need to fight against. So we're so focused on fighting volatility as the enemy, trying to suppress volatility or even eliminate volatility, that we've ignored the real demon, the real monster in this scenario that's chewing up our purchasing power over time. So what we need to preserve, or to use our industry terms of conserve, people think, well, I'm conservative. Well, you're conserving temporary principal with bonds and fixed income. What we need to do is conserve or preserve long-term income, right, which means we're going to have to ride through temporary volatility to have more security in the long run.
That makes sense. One of the things I say, going back to that orchard, is the real enemy is the guy that comes down and chops down 3-4% of your trees every single year, which is inflation, right?
Yeah. Or it steals your apples, or however you want to look at it. But the average person retiring today, according to the U.S. Census Bureau and Social Security Administration, would have been born around 1962. So during that time, what $100 would have cost in 1962, as of recording right now, would cost about $1,000 today. So your dollar would have lost 90% of its purchasing power just in the lifetime of the current retiree.
Wow.
But the dividends on the S&P 500 have gone up, I believe, almost 50 times during that same period.
Wow.
So
that's huge.
So there's a built-in inflation protection there in owning companies that produce the goods and services. So as costs rise, they're going to ratchet up prices to make sure that their cash flow, their profits can mitigate the inflation, stay ahead of that. And that's what we've seen happen since like 1786. But people don't realize that because inflation happens slowly. So just to give you another metaphor, nobody likes working out. You like running, but you're different.
You'll forgive me for that.
Yeah, I'll forgive you for that. Thanks. But that's not fun for anybody. And I'm going to have to go do that here in a few minutes.
For me.
Yeah. It's painful. It hurts. And it's very obvious. But the slow accumulation of plaque in somebody's arteries on a minute-to-minute basis doesn't really change that much. It doesn't bother. It builds up slowly over time. And we know that, if I go out and run, my lungs are going to hurt. My legs are going to hurt. It's going to be uncomfortable. It's way easier to sit on my couch and eat pizza. But that temporary comfort is putting you at much greater risk. Inflation is like that plaque that builds up in somebody's arteries.
Okay.
And you don't notice it day to day. By the time you're really aware and cognizant of what's happening, it's often too late. Sure. Because you've had a heart attack or a stroke or something like that. And that's what happens to retirees. I mean, yeah, they have heart attacks and strokes too. But from a financial standpoint, by the time they've realized how inflation has impacted them, it's too late to do much about it. Mm-hmm. And it's not about losing money or temporary declines that people need to worry about. It's outliving it. Because the average person, the average two-person retirement today, looking at, again, a 62-year-old couple, is about 30 years. That's what mortality and actuarial tables are predicting. So that means if you two-person retirement, 62-year-old non-smoking couple, there's about a 50-50 chance at least one of those people will make it into their 90s. Wow. So in a 30-year period like that, even at average 3% inflation, costs will go up about 2.5 times. So if somebody is living off of $100,000 today, by the time that their joint life expectancy has expired, they might still be alive, but just looking at their joint life expectancy, those costs would have risen to about $250,000.
Wow.
So as a retiree, yes, your 401k balance going down 15% last month or going down 20% last year or whatever, that gets your attention. But do you have a plan to double or triple your income over the next 2 or 3 decades? That's the question that people need to be asking themselves, not how can I keep my investments from going down next quarter?
Sure. Okay, so coming back to this fear and risk, the fear and risk piece, what about the question, what about the collapse of the dollar in the midst of all of this? What if OPEC decides to use the Chinese yuan? Now what do we do?
Well, we've already seen the collapse of the dollar. Like if the dollar has lost 90% of its value in the last 6 decades, that sounds like a pretty good collapse to me. Right. And here's the beauty of owning companies is it doesn't matter what they're denominated in. Like whatever they take their payments in, whether it's the US dollar, the Canadian dollar, the euro, Dogecoin, Bitcoin, what's the Iraqi dinar? Like, it doesn't matter because their value is not in their currency. Mm-hmm. Their value is in the product or service that they produce, and the denomination of currency that those things are bought and sold in can change, but. Gotcha. It's what they provide, what they produce. That's where companies get their value. So even as the dollar gradually gets inflated away, the value of what the great companies of the world are producing continues to rise. Mm-hmm. And it's proven time and time again that owning companies, and we talk about that, we're talking about owning large diversified portfolios where you own very little of any one company, but you own many, many, many companies. It's, again, the whole idea of you don't have enough money in any one company to make a killing, but you don't have enough money in any one company or even idea to get killed by it. But you own what's actually producing the goods and services of this world. So as a currency as a currency declines in value relative to other currencies or just in general purchasing power terms, you own what's producing all the goods and services that people are providing.
Rather than owning these companies, though, can't I just buy a whole bunch of gold? I've been listening to AM radio, and they're constantly telling me to buy gold.
Well, gold is great if you're making jewelry with it, but it's not an investment because it doesn't actually produce anything. The only way for gold to make you money is to buy it at a low price and sell it at a higher price. And that seems really obvious. Mm-hmm. But going back to our orchard example, if you don't have to sell your orchard, it doesn't matter what the trees are worth. You just collect the income they produce. Because when you own companies, you don't have to sell them to make money. Those companies have earnings, they have profits, and they send some of those profits onto the shareholders, which can be you and me and the blue collar millionaires that we work with. But with gold, it's just a hunk of metal. It doesn't produce income. So you have to be able to buy and sell at different prices, which makes you a price speculator, not a true investor. And we already talked about people misinterpreting volatility as risk, but that is what scares people out of their investments is temporary volatility. And the problem with gold is it has all the volatility of a diversified stock portfolio, mm-hmm. with a fraction of the long-term gains.
Gold goes up and down as well.
Gold goes up and down as well. And it has a lot. If you look, gold has barely paced inflation during my lifetime.
Wow.
Gold has barely paced inflation. And if you look back 200 years, an ounce of gold 200 years ago was enough to purchase a nice men's suit. An ounce of gold today can purchase a nice men's suit.
Interesting.
With an unbelievable gut-wrenching amount of volatility along the way. So at best, gold might help you preserve some of your purchasing power, but we're talking about growing and building wealth. And if you can sit through all the declines of gold, then you can stomach the temporary declines in equities as well with far more returns.
So bottom line, how much do I need to worry about the next 6 months with my investments?
Focus on long-term income.
Okay.
Ignore the temporary. And if people looked at the dividends that their investments produced, even if you're not taking them as income, because let's say you're 45 years old, you're working in a 401, you got a 401k, look at the dividends that your funds produced this year versus last year, or this quarter versus the same quarter last year. If people focus on what their dividends did every quarter, instead of the value of all their funds every day or every week, people would not only make fewer mistakes, but they would actually enjoy the investing process much, much more and have far less anxiety.
Are those dividends quite a bit more consistent?
They change very slowly.
Okay.
And the dividends, they're not as flashy, but the dividends are the income that these things are producing. And it's a good parallel to the fruit in our orchard analogy. But that should be the focus, because again, it's your income that provides financial independence. And I think the other thing to remember too, Greg, is there's no such thing as no risk. So when you are owning companies through mutual funds, there is a lot of temporary risk in day-to-day price fluctuations, but the real risk is the emotional cost of seeing that happen. It's not really a big financial risk. If you need $2 million to retire comfortably and you've got $1 million, does it matter from a financial standpoint if your $1 million visits 800,000 on the way to 2 million?
No, it doesn't matter.
It doesn't.
Right.
Is it uncomfortable?
Certainly.
Does it hurt?
Oh, yeah, a little bit.
Yeah, it's really frustrating, but it doesn't change your financial security. It doesn't add real insecurity, but there is an emotional pain and cost to that. But it's much better to pay that price than pay the price of inflation and loss of purchasing power, which is permanent. And for the sake of most situations, irreversible. That's what we need to avoid. That's the risk that we need to be focusing on. Going back to where we started with fires, like that's what we need to put out, is having a game plan to make sure that our income can rise at least at the rate that inflation is burning away our purchasing power.
How do we do that?
Owning companies and not lending to them.
All right. And that's part of what we do, is we help you guys get settled or situated with a plan that will outpace inflation and will last for a long time.
Yes. And just say it kind of in closing that bringing a fixed income into a rising cost retirement is a recipe for disaster.
A fixed income into a rising cost environment.
Rising cost retirement. Yeah. Bringing a fixed income into a rising cost retirement is a recipe for disaster. Like and the companies of the United States and the world have proven decade in, decade out for really centuries that they can reliably produce that rising income that keeps up at least with the rate that we are losing our purchasing power due to inflation. And that's what I think can create with the right planning and with the right help, can create financial independence to keep people not just retired, but comfortably retired for a very long time.
Awesome. Well, thanks, Chad. That was good.
All right.
Let me turn this one off. Yeah, that was good. That was a little bit longer one.
Thanks for listening to the Blue Collar Millionaire Show. We hope this episode has been inspiring and beneficial to you. If you want help on your journey to financial freedom, reach out to us at veritasalaska.com. We'd love to sit down over a cup of coffee with you, either here in our office or virtually, and get to know you and your needs. And though this podcast is free of charge, we do ask that you please do us 2 quick favors. If you enjoyed the episode, give our pod a great rating on iTunes or whatever podcast platform you use, and also give us a follow on Instagram. We hope you have a wonderful day filled with gratitude and intentionality. God bless.
The information expressed is for general information only and is not intended to provide specific investment advice or recommendations for any individual. It is suggested that you consult your financial professional, attorney, or tax advisor with regard to your individual situation. Hypothetical investment results are for illustrative purposes only and should not be deemed a representation of future results.